From the opinion pages of the Wall Street Journal, this is Potomac Watch.
U.S. employers add 250,000 new jobs on net. Bitcoin hits $100,000, and inflation is still stubbornly stuck above 2%. Let's check in on the state of the economy with a little over a month to go until President Trump takes over from Biden next year on January 20th. Welcome, I'm Kyle Peterson with the Wall Street Journal. We're joined today by my colleagues, columnist Alicia Finley and editorial board member Mene Ukwe-Barua. On Friday, the Labor Department released its latest monthly jobs report, this one covering November and showing steady growth in net employment. The overall number is non-farm payroll up by 227,000 on net in November, 54,000 jobs in healthcare, 53,000 in leisure and hospitality, 33,000 in government. That tends to be a pretty steady number, at least in recent months. Alicia, would you add this to the evidence that we have seen lately, including Bitcoin hitting $100,000, the Dow Jones Industrial Average being near 45,000, the evidence that the economy and financial conditions are not as tight as some seem to think, particularly as the Fed considers potentially cutting interest rates?
Well, I think this jobs report, there's a little bit of a noise because it's mostly bounced back from the last jobs report. If you recall, there were some storms in October, and the employer survey was actually kind of disrupted by the storms. And so you actually saw quite low job creation for that month. And then you also had the Boeing strike. So the 227, despite the bounce back, is actually a little lower than job creation than it was earlier this year. We've got average around 180,000 for the last 3 months. And it's steady as she goes, right? So it's not a bad job number. It's not like the job or the labor market is super tight either. This is kind of where you think it's in the Goldilocks zone for the Fed. Employers aren't laying off workers. The economy, there isn't any real sign of a slowdown around the corner. It's concerning that healthcare, government, and social assistance continues to make up a disproportionate share of the job gains. That's really been a trend over the last year or two, and those are industries that are largely supported by government spending. Wage growth, I think that's something you have to look at. It's still 4% year over, and it's actually accelerated in the past few months, and that's going to continue to push up inflation and prices. And you're seeing that in that disinflation has slowed since June. You haven't actually seen any continued decline in the CPI or the Fed's preferred index of personal consumption expenditure since June. So that's stalling out, which also suggests to your point that no, markets aren't financial conditions aren't particularly tight. In fact, there seems to be a lot of irrational exuberance. And betting, a lot of this is leveraged, by the way, and that shows up in Bitcoin prices exceeding $100,000, which is just mind-blowing. And Dow at 45,000, it's up. The NASDAQ is up over its price to earnings ratio is close to 35, and the same thing for the Russell 2000, which is small cap stocks, which tend to be a little more risky. All of this suggests, it's like risk on. Investors don't seem worried about the economy, and monetary conditions seem to be pretty easy. There's no shortage of liquidity in the system.
Mene, what's your sense of where the economy stands as President Trump gets set to take over for his second administration? And one more piece of fodder I would throw out here is the inflation numbers, which are still slightly above the Fed's target of 2%. The Fed's favorite yardstick is the PCE, the Personal Consumption Expenditures. And the Bureau of Economic Analysis on November 27th had the latest PCE report come out. PCE price index up year over year, 2.3% in October. And core PCE, that excludes food and energy, which tend to be more volatile sectors, that was up 2.8% year over year. So, Mene, it seems to me that the inflation problem has not quite been solved, and pretty soon it is no longer going to be a problem that's on Joe Biden's desk. It's going to be on President Trump's desk.
Exactly. I think the first major challenge for President Trump is going to be to make sure that wages can continue to outpace inflation. As Alicia mentioned, hourly wages are up 4% over the past year. It took President Biden a very long time to get to a point where wage growth was outpacing inflation. Obviously, we've seen inflation come down quite a lot since its peak in 2022, but the rate of the decrease of inflation has stalled now, which means that if we want people's wages to be able to catch up with the increase in prices that we've seen and continue to see, that wage growth number is going to have to increase, and that's going to require pro-growth reforms in the economy. President Trump also is going to have to implement these reforms to compensate for a decrease in government spending over time. I think a lot of the government spending numbers that we've seen and a lot of the growth in government jobs is still coming from some of these state-level surpluses in the wake of COVID. When their revenues started to increase, they had originally furloughed a lot of their employees, and it took them a while to start rehiring after that. But we've seen over the past couple of years, states expanding their workforces again, states spending more, but that is going to run out. They're not still getting massive amounts of supplemental cash from the federal government as they were over those first couple of years. And so that's not going to be able to carry so much of the load in terms of spending throughout the economy. And we're going to have corporate investment picking up some of that slack. And that's exactly what President Trump has pledged to do with the tax cut extensions that Republicans are planning to pass. The idea is it will give companies an incentive to invest more robustly. Particularly, they're going to want to restore full expensing for capital expenses for some of these businesses, which under the 2017 tax cut law, they were able to automatically expense the full amount of things like equipment and plants that they build. That amount has now decreased significantly. And so that's one of the things that they'll look to restore. And hopefully in the monthly GDP numbers, you'll see a tick up in a private investment as a consequence of those types of reforms. And so Republicans are already deliberating about the schedule for getting a tax cut bill put into play. And when they look under the hood of some of these economic numbers, that should give them a sense of urgency for getting it right and doing it relatively quickly so that businesses can start to make investment decisions based on what the tax situation is going to be.
Hang tight. We'll be right back. Welcome back. Journal had an editorial this week talking about the price to earnings ratios, which recall the figures that we were seeing kind of in the middle of the dot-com bubble. Are the people who are pushing up the price of Bitcoin, is that some expectation that the Trump administration is going to be more friendly to crypto? Or is this another example of a kind of a meme stock shift in real money that is flowing into the system? Or maybe is it a bit of both?
Well, I think there's a little bit of both, betting on that more crypto-friendly administration. But recall that Pat Gelsinger actually wasn't hostile to Bitcoin. That was probably the one token he wasn't hostile to, and said that it's not his securities and he wasn't going to try to regulate it. Now, I think some of the bets is that there's this company, it's a software company, MicroStrategy, that's been around since the 80s, but lately it has a different business model, which is to accumulate Bitcoins. And so a lot of people, investors, hedge funds who don't want to own Bitcoins are actually investing in MicroStrategy, buying its stock, or actually buying these convertible notes. And what these are is it's essentially, they're kind of like bonds, but they have zero or very low coupon. And then they can convert into stock or equity into a company when the price hits a certain point. And so these are really just bets on the MicroStrategy stock, which has been fueled in part by the increase in the Bitcoin prices. And so this is kind of what's known as momentum trading, whereas Bitcoin pushes up MicroStrategy stock and vice versa. But there is a lot of leverage going on. A lot of this is being fueled by hedge fund traders, and they're employing different strategies and arbitrages. And the concern is that if there's a margin call or something like that, all these trades will start to unravel and the price of both will start to plummet and people are going to lose their shirts over this. You mentioned the price to earnings ratio, and I do find it very concerning how elevated it is. One benchmark, like whether markets are becoming too frothy, the historical price to earnings ratio for stocks is around 17, 18. 17. Tesla's is now nearing 100. But even the Russell 2000 and the NASDAQ, it's around 35. And that's near dot-com bubble levels. And so what goes up inevitably will come down. And there is concern that some people are going to lose a lot of money if something causes markets to tumble.
Monet, you talked about the debate over tax reform, which is going to be a huge argument within the Trump administration and within Congress, how to proceed on that. The other piece of this, where I think the president and the new administration is going to have a real economic effect, is with President Trump's deregulation. I think many people in the business community and out thought that his first administration's deregulatory efforts were a success. And particularly, if I could pick one thing, just on the energy side, if President Trump and his cabinet officials roll back pauses and limitations on building export terminals for natural gas, for example, that's something that could have a real economic effect. And I don't know how quickly, but certainly it seems to me over the course of the 4 years of his term in office could be a boon to U.S. jobs and to payrolls and wages.
Well, that's definitely true. And if you look at the way that the stock market moved immediately after President Trump's election, there was a lot of activity in industries that are heavily regulated, oil and gas being first and foremost among them, because people realize how much influence the presidency has on output in those industries now more than historically. And so the private sector is definitely betting that they will be able to see the effect economically of that type of deregulation. The question is how soon it will lead to actual changes in output, and that will definitely vary. Of course, we saw a lot of litigation challenging Trump's deregulatory moves during his first term. A lot of those moves ended up being reversed. Of course, he has brought on Elon Musk and Vivek Ramaswamy to try to make that deregulatory push a lot more rational and efficient and hopefully much quicker than it was before. But still, also companies realize that there's always the potential of those deregulatory moves being reversed again. And so that complicates and sometimes delays their ability to make investment decisions based on it. And so it definitely is an extremely important piece of economic outlook under the Trump presidency, but that needs to be paired with legislative changes, which create much more dependable, longer-term environment for companies to be able to make their decisions based on.
Another piece of the argument will be rolling back green subsidies, industrial subsidies, which have proliferated in the Biden administration. Notable, Alicia, that the CEOs of Intel and Stellantis recently said that they would soon step aside. Do you think there's any tie here to the idea that those companies might soon be losing the kind of policies, the green agenda policies that they had been relying on?
Well, I think they were related problems, or the Stellantis CEO and Intel CEO, Carlos Tavares and Pat Gelsinger, faced related problems, but somewhat different in a way. So Intel's problem actually goes back more than a decade, and you could probably actually root it to the industrial policies of the government going back decades, which were somewhat protectionist and kind of tried to shelter Intel. Now, Intel also the executives had made some bad bets. They decided not to make chips for the iPhone. They didn't think that there would be profits and that the iPhones would be a big success or be a successful product. And so they passed up that opportunity. And then they just didn't foresee the AI boom. And so they bet more heavily on becoming an integrated company. And by that, I mean the fabricating chips as well as designing chips for their PCs and servers. It's actually the only large company that does that. The problem is it never really became good at either. It did get a lot of PC server business, but it has lately been eclipsed by AMD and NVIDIA in AI, as AI has increased demand among tech customers. And so Gelsinger's big bet on fabricators or foundries, which is incredibly expensive. The only real two other competitors are Samsung and TSMC. It just became a money suck. And he lobbied the government for this big chips package, which included about $40 billion in grants, as well as a 25% tax credit for these new factories. And Intel was a big beneficiary of the package. It was recently received an $8 billion grant, but that doesn't compensate for all the losses and the fact that it just couldn't find customers actually for some of the chips it was designing and was trying to manufacture, which resulted in the delay of construction of some of its factories. So I think it was depending too much on government help. Now with Stellantis, it had a problem of it was really profitable during the pandemic, as were some other automakers, because there's a shortage of supply, which pushed up prices and pushed up profits. But didn't really invest in gas-powered cars, especially for the new models of gas-powered cars that really form a lot of the automakers' profits, the SUVs and pickup trucks. Meantime, it was pumping more money in the EVs, as the government is requiring them to make, that haven't been selling. Now, this is a problem for all automakers, but the problem for Stellantis is it just didn't have the profits from the popular SUVs and pickup trucks to help subsidize that transition. And it was having to eventually this year, because of dealer complaints, cut prices a lot to get the cars off the lots. And so it just became a financial squeeze that was unsustainable. And meantime, the dealers in Europe, which is also a big market for Stellantis, more for its smaller cars, they were complaining for different reasons that its EVs weren't selling, and they wanted a rollback of the regulations. And the CEO, Tavares, was actually supporting maintaining them because he thought that they would benefit Stellantis, which was planning to import cheap EVs from China under its Leap Motor brand, which obviously did make Stellantis' European dealers very happy. In any case, this is a long way of saying that both of the CEOs made really bad bets. They made business mistakes, and ultimately, the shareholders and the investors and the board held them accountable. Government may reward failure, but investors still expect results.